Hey everyone, I'm Joe Dobert. I'm the founder of Dayton's Bluff Financial up here in St. Paul, Minnesota. I'm going to talk to you a little bit tonight about mortgage protection. And the reason for that is twofold. First of all, a lot of our new clients come into us asking about mortgage protection. There seems to be a lot of misinformation out there about it. Although when you close on your house, you're going to find that you're buried in mail from the insurance companies trying to get you to buy it. It's amazing how quick and how fast those pile up. My dear friend Mitzi, who's just a rock star realtor down in North Carolina. I've known Mitzi. Well, Mitzi's aging better than me, so I'm not going to say how long I've known Mitzi because you wouldn't think she's as old as I am. But I know that there is some confusion about mortgage protection out there, so I'm hopefully going to clarify some of that for you tonight here. First of all, what mortgage protection is not is homeowners insurance. A lot of people are confused. They think that when they closed on their house, they were already protected. The thing is that when you close on your house, the bank is protected. I mean, if you haven't worked with me directly, you'll know that I have a no BS rule. And here's the straight scoop on that is the bank doesn't care if you can make your mortgage payments or not once you've signed for the house. What they want to know is if you burn down their collateral, are they covered? If a storm picks up their collateral and drops it in the next county, are they covered? Any structural issues, is the bank covered? So of course you have to have more homeowners insurance before you leave the closing table. I think that was one of the first things I had when I closed on my house. They don't care if you have mortgage protection. And if you ask your banker, do I need mortgage protection? They may talk you out of it. By the end of this video, hopefully you'll start to question that and wonder why, because after I worked at a large bank here in Minneapolis for about a year, and it was the longest, most soul-sucking, hellish year of my life because it's driven by greed. It's not driven by protect the consumer. So understand that homeowners insurance protects the bank. They're covered. You didn't get those keys until the bank is taken care of. Mortgage protection is what covers you, though. This is what keeps you from losing your home to the bank. So here are some of the things that can cause you to lose your home, and specifically lose your home to the bank through inability to pay. Death, chronic illness, critical illness, disability, unemployment. Those are the big six that come to my mind. And those are the things that a mortgage protection plan can protect you from. So let's start with the easy one, death. If your family is counting on you to make that mortgage payment, then death is going to cause them to possibly lose the home. When you die, your income stops. If you have even a little bit of life insurance through work, that's great, but don't overplay your life insurance through work because it's usually a year or two of your salary, right? Even if you bought extra insurance, it's probably not going to cover your mortgage when you die. And you can, pick up the newspaper any day and you'll see companies taking away benefits. So let's not count on our life insurance at work to pay the mortgage, all right, in the case of death. A mortgage protection policy will contain a death benefit always. That can either be the full mortgage, or it can be enough death benefit to pay the mortgage for a year or 2 or 5. I like to work with my clients on a budget that fits. And I should probably say this for a bigger blog post, but I will tell you just a little nugget in this video is typically I shoot for about 5 years of mortgage payments if the full mortgage amount is out of their budget. The idea is that statistically it takes about 5 years for a remaining spouse to regain their full earning potential. There's the grieving. There is the time off to deal with things like suddenly being a single parent, taking care of all the bills, doing everything that you guys did together in the past. It's a nice cushion that gives them time to figure out what to do. But the gold standard for mortgage protection policy is always, if you can afford it, the full mortgage. Now, chronic illness, critical illness, disability, those things that are, think of sicknesses or health events that could cause you to not be able to work anymore. I usually use heart attack, stroke, and cancer as the big ones. Those can be things that can cause you to be, have less than 24 months to live, or you're suddenly you're not able to. You have a stroke. You're not able to bathe yourself and take your medications alone. Things like that we can use what's called an accelerated benefits rider to. Well, the simplest way to explain it to you is that you cash out your policy. You take an advance on the death benefit. Some carriers will let you take up to 100% of that death benefit and use it in the event of one of these triggering events. So imagine, you're terminally ill, you're in hospice, but you want to die at home. How are you going to do that if you can't pay your mortgage? Well, that's where we use those accelerated benefits riders. So when I'm sitting with single people, they often don't care about that death benefit as much. It's really those living benefits, the ability to stay in the home after they die, that's important to them. I will probably link on our website or post in our learning center some of the nice testimonial videos that some of the insurance companies have done. I don't do anything flashy, fun like that, but you'll see what it means and maybe see firsthand. For me, that's what I really think is important for my clients. Now, we'll come back to unemployment in a moment. At the time I'm filming this, it's Friday night. GM is just in I don't know, October something. GM just today has announced that their strike may be ending. So I've got clients who've been out of work for the last month. So I'm going to talk about that in a minute. There are, to my mind, there are 3 good ways to put together a mortgage protection program for someone. The first and the least expensive way is using some sort of declining balance product. Typically, I use a universal life policy with a declining mortgage rider on it. And the reason I do that is to back up, I only use indexed universal life. We don't use anything variable, nothing that could lose money. As long as you're making that minimum premium payment, it's never going to lapse. And I try to project it out past age 100 for you to make sure that it's going to outlive you, so that at the very end you have a death benefit. Now, I like to start at the full mortgage amount, and we set it up so that it works its way down, usually to, if we're trying to stay as, we're doing this because it's an inexpensive way to do it. So I put that final death benefit at $25,000. For most carriers, that's their threshold. So it pays down at any point on there. You should be pretty close to what your mortgage balance is. It's obviously never going to track to the penny, but the illustration software we use gets it as close as possible until it hits $25,000 in death benefit, and then it levels off. I like that. I think that's really a good way to give you a policy that will outlive you as long as you make the premium payments and that still covers the mortgage. Because it's a universal life, it's going to have the living benefits, at least in the products that I illustrate. And I should tell you not to take this as go out and do this without seeing someone, because life insurance is not a do-it-yourself project. You need a professional to do this because it's your life we're insuring, right? This isn't just your car. It should illustrate it down to about what you're doing. You've got the living benefits there, though, which means that halfway through, if your death benefit is $100,000, going down to 25, say we get to a point where you got an $80,000 death benefit because we've been moving through the policy for a few years. If that's the point at which you have, say, some triggering event for which we can cash out the full 100%, you have $80,000, all the way down to the 25. I like to do that. That just adds that little extra protection beyond the death benefit. It also is building a cash value, which comes back to that unemployment piece. Now, we're going for a budget-friendly policy, so you're not dumping cash into this thing. So don't think that this is going to get you rich. But there's going to be sufficient money in there at almost any point to pay the premium, at least, if you're unemployed, if you can't make the payment. If you want to buy your insurance agent lots of gifts for his birthday. Whatever the case is, there's usually money in there that you got that little bit of wiggle room. Not so good for saving a lot of money for retirement, but we'll get there. Another really good way, and this is probably my favorite way from a consumer perspective to to put together a mortgage protection plan, is to do a level term, level death benefit policy. What that means is that at day one, if you die, you're going to get that full face value. I think there are 11,000-ish days in a year, or in 30 years, so just say day 11,000 or whatever the last day of a 30-year term would be. If you die, you're going to get that full death benefit. So if it was a $100,000 policy, it's $100,000 day one, $100,000 day 11,000. Your mortgage was $100,000 day one in this example. It's not $100,000 at the end. It's hopefully paid off on that very last day. But you're still going to get that full death benefit. That's why I like this. It can build in a lot of cash for your family if you die near the end of the term. If you don't die at the end of the term, it still has plenty of money to pay off the full mortgage, which was the original purpose, right? To pay off that mortgage if you die. And at any point in there, you should be able to accelerate those death benefits if something happens to you and have enough to pay off the mortgage. So it meets that mortgage protection standard, but it gives your family a really nice chunk of money if the mortgage is paid off. Which is a good time to tell you that mortgage protection is not paid to the bank, because remember, I don't like the bank. We're not protecting the bank, we're protecting you. So your significant other, your spouse, your kids, your whoever, someone who's counting on you financially is the beneficiary. The bank isn't. The bank can pound sand if they need to. I mean, it doesn't take a walk bank. We don't care about the bank. What we care about is you and your family. So I want to throw that out there so that if we haven't worked together yet, you understand where I'm coming from. My favorite way is to use an indexed universal life policy, like the first example, but to do it with a death benefit that's sufficient to cover the whole mortgage, and then let it increase after that. Or start something close, let it increase throughout. Either way, we would illustrate it a couple ways to see which way makes more sense for you. But the idea is that we want to be putting enough money in there to cover the full amount of the mortgage, to have the full death benefit at the end of the mortgage. And we want that universal life, that cash value, to increase as much as possible year after year after year. Now, life insurance is not taxable when it's paid out to you, right? That's why we love life insurance. Tax-free money. An IUL doesn't lose money because we're in insurance. We protect things. We don't risk things. If you want to gamble, go to your stockbroker. If you want to protect your family, go to your insurance broker. It's going to accumulate cash though throughout the year, which at retirement you could cash out if you need to. Take out loans, and don't cash it out typically. I misspoke there, and I'm not going to go back and edit this video because we don't do flashy. I want you guys to see raw as it comes out of my mouth. But at retirement, start taking out money every month. Take a loan to help supplement your retirement. And if you're working with me, we can talk about how to do that, how much you think you'll need, what you could do. You've got a lot of flexibility in what you put into an IUL, and then you just take a loan against that. It's tax-free retirement income. Another neat trick with an IUL is if you're having new kids, so say you got young ones, is that we fund that to the point that we can illustrate based on the last decades of the last many years of historical growth. We can illustrate where it should be 20, 30 years from now. We can look 21 years from now. Where's that policy going to be? Are we putting enough money in it that we should be able to withdraw money to pay our kids' tuition? A neat trick there that I learned from a really good guy was, instead of doing it at the year that they enter school, let it grow for an extra 4 years. When they get out and they start paying those loans, that's when you start taking the money out and paying it down. But we'll illustrate it both ways, right? Whatever. My point is, we let that grow. We start taking out tax-free money later in life when we really need it. Now, this comes back to that unemployment example, and my friends up here at GM is, imagine how nice it would be to be on strike. Now, they get a $250 strike benefit, I think. Imagine how nice it would be, though, to be able to take money out of your IUL to pay the mortgage, to pay, keep food on the table, to do whatever else you need to do, to have that flexibility to take that money out tax-free if you absolutely needed to. I think that's a huge level of protection, something way beyond what people think that mortgage protection can actually do. So if your banker says, "Oh, you don't need mortgage protection," it's because they don't know what the hell they're talking about, right? No offense, bankers, but if someone says you don't need an insurance product, ask them for their insurance license, because they probably don't know. Think about the last time they sat down with you and did a real thorough needs assessment. The last thing I want to say about this that's really nice for my clients, and I just wrote about this, but I framed it in the terms of final expense coverage. But if you go to the Learning Center at Dayton'sBluffFinancial.com, you'll see an article about getting life insurance without a medical exam. These are typically available in what's called simplified issue, which means that you don't need a medical exam. We don't have to send a nurse out to take your blood, take your urine, plug you with EKG wires. It's usually just medical questions. The application is simple. The underwriting is pretty generous. You would be surprised what conditions you can have and still get a policy like this. It's a little tougher than a whole life policy, but geez, I've seen people get covered that didn't think that they were going to, and they're all affordable. Don't write this off as something that you can't afford or that you just won't get qualified for. Call us and ask. We'll talk through it on the phone. We'll do whatever we need to do to help you understand it. Which is really all I have to say about mortgage protection. I think that, I'm told that you guys like to learn things better by video, so I'll try and do this pretty regularly. But I will tell you that my philosophy with my clients is buy insurance or don't buy insurance. That's up to you. I can't push you to protect your family, but at least let me give you the information. Let's do a real needs assessment and let's look at the numbers so that you're making an informed decision about whether or not you want to protect your family this way. Don't take advice from your dentist. Don't take advice from your realtor. Don't take advice from your banker. See a real professional, a licensed agent that you know and trust. If you don't have a licensed agent in your area or don't know anyone, give us a call. We're happy to help you. And if you're not in our area or someplace that we can help you, we will refer you to someone that we know and trust. That's it. Take care. Comment, do whatever you need to do. Email us. Let us know if there are any just burning insurance questions that you got out there. Otherwise, have a great night, everyone.